Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis, Tuesday, March 17, 2015. You're looking at a quick agenda and inside the numbers, look at what we're going to discuss tonight. We're going to talk about a Mobileye trade. We're going to review the trade. We're going to see the it's a very profitable trade. You're going to see the setup. You're going to see where we are, where we took the trade, and then where I think it's going from here. We're going to talk about the SPY, the E-mini contract also, with specific resistance and support targets. I'm going to give you the numbers. We're going to talk about crude oil, a particular trade that happened, where I think crude is going moving forward, and I'm pretty sure it's going to get there. Gold, we're at an inflection point where we are today, where I think we're going. Interest rates and the bond market. We'll talk about what's going to happen around the Fed meeting, where we were in interest rates in the bond market and where I think we're headed, and another profitable trade that we'll review real quick. Let's go to Mobileye. And the members got the trade alert at 34.75, right in this neighborhood here, okay? There was a particular indicator or multiple indicators that were signaling to me that the turn was imminent. And what this depicts is very interesting because if you look at the date, okay, issued the trade alert on the 4th of March. Let's go over to the SPY for a second and go to the same day, the 4th of March. The 4th of March, the market started down the day before and went down for another several days in a row. Okay, back to Mobileye. What this says, or at least what I know to be true and what I believe and how my research is done, is that each individual market has its own set of circumstances, its own way of trading, and its own cycles. And my analysis told me that Mobileye was bottoming. We had indications that it was bottoming, and when we bought it, we did get a pop right away, which was great, which enabled us to put a break-even stop in, and we took half the trade off the table. This is the way I like to trade stocks. Once you get a quick gain, I like to take half the trade off the table and put a stop either break-even or in the money. And why do I do that? I do that because you don't know how high a trade is going to go, and you don't know when a trade is going to begin to fail, and I don't want to ever let a positive return turn negative. In this business, you have to protect your capital like it's your baby's, okay, like it's your child. You have to protect your capital because it's all you have. In order to make the next trade, you have to have the capital to do so. If you continue to make bad decisions and lose capital, you lose interest in trading, and this is just the paramount to protect your capital, and risk management is everything that I'm about. So what I do is, after I'm up, in this particular case, it was up a few dollars. Let's say I had 1,000 shares. I took 500 off the table, put a stop in the money with a trailer on it. And what that means is that, let's say the trailer is $1. So every time that Mobileye moves up $1, my stop moves up $1. And if Mobileye ever comes back in, I let the market stop me out. I don't have to make the emotional decision. I don't babysit the trade. Once I have a break-even stop and I've already got a profit, guess what, folks? It's a guaranteed winner. There's nobody that can take that profit away. The worst case is you have the profit that's already in your pocket. Okay, so that's the way to trade stocks. And if you want some more trades like this, then become a subscriber. Give us a shot, mystrategicforecast.com. Sign up. You'll get the trade alerts. You'll see what it's like. And then if you want to continue, you do so. If you don't, no problem. Let's go over to the SPY and we'll talk about where we are. In fact, you know what? I'm going to focus in the S&P E-mini contract because I have very specific numbers and I want to discuss them here. So here's where we are. The market traded, it kind of traded like almost normal. I mean, more times than not, you see the market do this, trades down in the beginning of the day, okay, and then in the late morning, it puts in a bottom and then floats up for the rest of the day. But what was interesting today was the market really didn't close particularly well, okay. We made a high. The high of the day was at the high of the day was at 2070.50. The most important number you can know right now is 2071. Any close, for example, tomorrow or even hourly begins, if the market begins to close hourly, the E-mini begins to close hourly above 2071, that's a very bullish sign and much higher prices are coming much sooner than people would realize, okay? However, If the market begins to close below 2065 hourly, you can assume that the probabilities begin to increase that we go down to 2050 and then 2030 and maybe even lower than that. But those are the two numbers that I can see on my radar screen. But here's the best part about this is from where we are now, right now we're at 2066 and a half. Where we are now, 2071 is not that far away. So you know where you're wrong. That's the most important part about being in this business is knowing where you're wrong. If I took a short on the market right here, okay, I know I'm wrong if hourly we begin to close above 2071. It's that simple, okay? So those are the numbers that are important for tomorrow, and keep your eye on them. There could be more downside. We do have an unresolved target on the downside at 2030, okay? And if that's going to be achieved, I believe it'll be achieved this week. Otherwise, if we continue up, then the market's in a very, very and extremely bullish position. All right, let's go over to crude oil. What a great trade today in crude oil. Last night's video, I told you that if crude oil went down and hit, what was the number? Let me go back to my notes real quick. The number was, and I put it in the email to subscribers tonight, the number was 42.70 to 42.60, and we got down to 42.63 or 43 on the low today, and then we reversed up and we went up to 44. What did we go? 44. Yeah, 44.20 up here. Okay. So that trade was given out yesterday in the video. The trade happened today. We went down here. Okay. The low was 42.63. I said 42.70 to 42.60. Pardon my getting tongue-tied with the numbers. And then we would reverse up and we would go past 44. We went to 44.20, right? Up at the high, 44.20. And then we reverse back down. Well, I didn't get that part, but I got the first leg, the first two legs. I got the low, the high, and then the trade was over. So that was pretty neat. So what do I think is going to happen here from this point forward with crude oil? Below $44 on a daily close, where we are right now, as long as we begin or remain closing below $44 on daily closes, very bearish for crude oil. Likely to see into the mid-30s over the next 2 to 3 months. Yes, mid-30s, next 2 to 3 months. I'll refine those numbers as time goes on, but that's what I see right now. All right, let's go right over to the gold market. Here's your gold futures market. Interesting day today. This is the 10-minute chart. See a spike up, and then we pulled back, and we always seem to pull back in the second half of the day for the last several days. But this spike up to me was meaningful, and my line in the sand is 1145. 1145, as long as we remain above, closing above 1145 on daily closes, the market is in a bullish position. If we close below 1145, something else is developing, and I'm going to probably change my opinion, at least for the short term. But that's the line in the sand, 1145. So we're going to watch it day by day. As long as we remain above that level, we remain in a bullish stance. And with all those events culminating this week, forget options expiration. I'm talking about stuff like the vernal equinox or the spring equinox, a new moon, a solar eclipse. You have a Fed meeting. Gold tends to get whippy around a Fed meeting. Could go down. Last Fed meeting it did go down, but nevertheless it does get whippy around the Fed meeting. So all these things, and we're at that inflection point. We're at that waterline or that line in the sand at 1145. So I think something's going to culminate this week, and we're going to go one direction or the other this week. And that's what I think is going to happen in gold. Let's go over to the bond market. We'll start with TLT. And let's go to the daily chart and review the trade, because here's another profitable trade, okay? 124.25 was the buy price for TLT. We got in. Now we're at least with a break-even stop or in the money stop, half off the table. We're at 129. I said last night we would find a lot of resistance up here at 129. And here's the kicker. Tomorrow's the Fed meeting. The bond market always gets whippy around the Fed meeting. So I like booking profits before a Fed meeting if I'm in TLT, only because owning TLT in and around a Fed meeting is like owning a stock around earnings. Who knows what's going to happen? They can beat earnings and the stock goes down. They can miss earnings and the stock goes up. Who knows what the Fed's going to say? Who knows how the market participants are going to react? We don't care what the Fed says. We care how the market participates after the fact. The market and the money flow tell us what to do. Where the money is flowing tells us what market is going to inflate. If money is flowing out of a market, it's deflating. If money is flowing into a market, it's inflating. It's that simple. So we just look for where the money is going. Go where the money is. Kind of like why do you rob banks? Because that's where the money is. Why did you buy TLT? Because that's where the money was going to be. Okay. Let's go to the interest rate market real quick, and I just want to remind everybody that I said if we closed below this green candle here, which the low was 2105, then we had lower yield prices or lower yields to come. That's where we've been, and that translates to higher bond prices. And let's take a longer view of the bond market, because I want to remind you of something. This is a reversal candle. Remember, just because bond market is going up now, and there could be lower yields and higher prices still yet ahead in the bond market, that's not out of the question. But at some point later this year, okay, this is going to play out to the downside, and you're going to have a lot of pain to be had in the bond market, and there's going to be higher yields to be had. Right now, that doesn't have to be the case, but that's what's coming later. This is a monthly chart. This will take a while to work out. This will take months to work out that way. I just want to remind you that the longer-term picture in the bond market is bearish. The short-term could still be bullish. However, right now we're in a profit scenario, so that's all we care about. I think that's it for tonight, folks. I'm going to leave it there. I'm David Frost, mystrategicforecast.com. Hopefully this has been helpful. This was another episode of Common Sense Market Analysis.